Hope everyone had a great weekend. Finally had some sunshine, managed to get the barbecue out, only to turn up and see my godfather wearing a t-shirt where he went on holiday about a month ago to Guam. Couldn't believe it. He actually said he went to Guam on holiday about 4 weeks ago. I'm sure he would have got a cheaper airline ticket right now than he would have gone about 5 or 6 weeks ago. But looking at the charts this morning, some moderate risk on activity. You can see this defined by the two center charts. You've got the DAX and S&P futures, both seen higher. The DAX, you can see, is gapped up, pretty much gapped up straight to R1, which is just above that high that we had on Friday's session, and we're already trading above R2 at the moment. Likewise, if you're looking at gold prices, we are trading at around S1, which is down about $4.50, and consequently, in terms of T-notes, bottom right here, down 5 ticks. So if you were talking about fire and fury, and that wasn't enough, it wasn't tough enough, these were sort of the comments of a very aggressive rhetoric which kind of spooked the markets last week and prompted pretty much the exact opposite movement that we've got this morning. So in reversal of this, and mainly down to the fact that over the weekend, as you've probably recognized from going through the various news agencies this morning, there really isn't any new developments. There's no real new commentary specific, no further elevation, let's say, in the situation on the Korean Peninsula, nothing out of Kim Jong-un, no missile tests or anything of that nature. And so it's just come off the boil slightly, let's say, in terms of a key market story. But certainly there are some other things to have a look at in terms of the press, and certainly Trump very much in the spotlight for other reasons at the weekend, but we'll have a look at that shortly. But one of the things here is just looking at with the S&P that was quite interesting is that I was just looking at the, if you remember, we were at record highs actually just shy of 2,500 towards the beginning, mid of last week, and I was just looking at the percentage of how much we've fallen from that record high down to the kind of North Korean spooked market low. Let's say we had a loss of about 2.3% in reference to the S&P. And what I was looking at was some analysis, quite interesting, by Deutsche Bank. Basically, they've been looking at the equity moves that tend to happen with major geopolitical events and a type of size of US sell-off that you typically see, specifically looking at the S&P 500. So as we can see here, from peak to trough, from really the second half of last week, we've sold off about 2.3%. And as you can see, if we have a look how much of this move that we've actually retraced, we go from the same point, peak to trough again, we're pretty much 0.38% retracement of that move is exactly where we're trading at the moment. But to put this in context, and with the Deutsche Bank analysis, is what tends to be the pattern when you have these kind of these situations. And let me just show you this table that they put together, which is pretty interesting because it dates back basically to 28 such events, major geopolitical news, dating all the way back to World War II, with what we're looking at here is the couple of things. The duration of the sell-off, so how long do we sell off for, and then what is the percentage size of the sell-off, and then how does the S&P then perform over a timeline going forward, that being 1 week, 1 month, 3 months out to 12 months. The distinct pattern here that we're looking at is the duration of the sell-off, and really, well, there's a couple of points that they highlight. Let me just sum it up for you in their concise fashion. They said, 1, the median sell-off size is about 5.7%. Secondly, it's roughly on average 3 weeks to find a market bottom, and then 3, another 3 weeks to recover to prior levels, and then 4, significantly higher markets 3 months and 12 months after that initial geopolitical event has happened. And actually, if we look at the chart that we had, that I just showed you, the sell-off from North Korea last week was about 2.3, 2.4%. If you remember the Syrian airstrike that happened, it was really, we're looking back at March, April time. That Syrian airstrike sell-off in the S&P was a similar type size to what we've had with North Korea last week. It was about 2.8%. And then if you fast forward about 3 months, we're in the S&P, we're up 5% since that point. So what tends to happen is that, through lots of different responses, but one, obviously it's a very human, behavioral driven market, and that when we get an escalation of development in geopolitics, the market reacts and reprices itself very aggressively, very quickly, in a kind of knee-jerk reaction. But then the recovery tends to be fairly gradual but very powerful, and can often be obviously accompanied, certainly in the likes of larger scale geopolitical events, by monetary stimulus and fiscal stimulus to help counter that, which the prevailing then bigger trend is quite a powerful rally. So just some quite interesting stats there that I picked out from the morning, but looking at the charts, you can already see we've managed to just claw back some of this nervousness that was apparent in the market. It's not to say that this has gone away. I think one of the good lines that I read this morning was that the worry this time round specifically is that you've got a Trump administration, and so it could be unpredictable in relative to its predecessors. Because again, when you're looking at these statistical patterns throughout history, obviously you've got to put it in context to the type of way in which the administration was run and the way that the politics kind of influenced it. And you would say we're in quite an unprecedented era at the moment under the leadership of Donald Trump, for sure. Couple of other things in terms of a timeline with North Korea. Kim Jong-un did say last week that they'd be ready to attack Guam by mid-August. So, of course, it's August 14th. This is mid-August. And so, although, as the charts are telling you this morning, there's been a little alleviation of fears, at least from the height of that nervousness last week, certainly if Kim Jong-un is good for his word, then this situation certainly isn't over. And so the idea of potential further test rocket launches and so on could be something to monitor. One thing we've had over the weekend, a couple of comments out of other senior US kind of officials. The CIA's director has said, "I have seen no intelligence that would indicate that we're on the cusp of a nuclear war," although said would not be surprised if North Korea tested another missile. Secondly, National Security Advisor McMaster said there is no indication war will break out. Just to add another dimension to this commentary, I also saw some comments from North Korea this morning in the press, and they've basically said that North Korea does not appear to have mastered missile re-entry technology, and it will take at least 1 or 2 more years to do so, although its ability to militarize a nuclear warhead is advancing quickly, according to South Korea's defense minister. If you remember, last week we were looking at the types of missiles of which North Korea has in its armory, and actually it was the longest ranged missile of which they've only used as part of their space program to launch 2 satellites, would be the one that they would have to use in order to fly a missile far enough to hit the US. And actually, in theory, that rocket works, but in practice it hasn't actually ever been used yet in terms of an intercontinental ballistic missile, only for satellite launch. And so North Korea, or South Korea I should say, are saying yes, they've progressed on the technology for miniaturization, but no, they haven't mastered the re-entry technology yet. So effectively they can't yet achieve what North Korea is saying, essentially. So you've had talking down from South Korea, the CIA director, the US, the National Security Advisor, and with no new comments really on the issue elsewhere as well from the weekend. And so hence you've got a little bit of this kind of risk on scene this morning. So as I'm talking here, gold coming under some further pressure. I was just looking at the Japanese yen there. You can see on the upside getting close to touching and testing on R2. So you can see here side by side yen weakness, gold weakness. So reversals from last week for these reasons we've just been mentioning. Okay, a few other things to be aware of. We did have some economic data out of the Asia Pacific session of some importance. Let's have a look at China firstly. You can see here China industrial production and retail sales. If we're just taking the year-on-year readings here, 6.4% below the expected 7.1 for IP in July. The retail sales 10.4 against 10.8. So both measurements slightly weaker than expected. So if I'm looking on that on charts here, China's growth gauges disappointing on the onset of the third quarter. You can see here distinctly, if you layer in fixed asset investment year to date as well, all three key measures have decelerated more than expected in July after outperforming in June. This really hasn't had too much of a read across into the overall market. In fact, actually, Hong Kong, the Hang Seng, was up about 1%. Shanghai Comp was pretty flat. There was apparently some firm liquidity operations conducted by the People's Bank of China that helped some of the sentiment to mitigate the generally weaker economic data that came out of China. Looking elsewhere, a few other things here in the headlines just quickly. Chancellor Hammond and Trade Minister Fox in the UK stating that Brexit transition period will be limited and will be intended to avert a cliff edge. So I'd say the Brexit talks have been fairly quiet. There's been a few murmurings in the weekend press about them now coming forward with some new white papers in order to break the impasse that seemingly we're at with the EU over this divorce settlement before we then get on to transitional and trade talks, which are obviously critical to the clarity going forward. But not too really much to talk about on that front. Looking elsewhere then, let's talk about Trump, because there certainly has been a couple of headlines coming his way, and all you would imagine would further damage his popularity. First of all, one going chronologically that was emerging towards the end of last week, and this was about Venezuela. So US President Trump stated on Friday he would not rule out military option in Venezuela. This obviously comes escalation in civil unrest. But he has been criticized in regards to, again, throwing around this kind of military option too easily and too off the cuff, that has made a lot of people quite nervous about that situation. You then start to layer this in, and I'm sure you would have seen a lot of the social media coverage, certainly on the news, about him being criticized for not denouncing white nationalists at a rally. I think it was Charlottesville in Virginia in America. A few people have died, multiple people injured, including police. This was about a rally where Donald Trump faced a second day of criticism after failing to personally denounce white nationalists and neo-Nazis and others who held a rally in Virginia that ended in a deadly car ramming attack on pedestrians. And so a lot of US politicians have been speaking out against the president in regard to that. So you've had this situation, you've got Venezuela, and you've got ongoing North Korea, of which, as I just mentioned, the likes of the CIA and the head of national security advisor, and also you had McCain last week, are all going against the president at this point in time. I guess there's kind of two ways to kind of view this. One is, does this bring about more thought about the timeline of which he can survive as US president before something would happen for him to be ushered aside? I think that's probably not the case. I think it's more about how much does the market really respond to Donald Trump, knowing that everyone is actually against what it is that he himself wants to achieve by what he's saying. And so by default then, there's not a great deal the president can do alone. What the president needs is the backing of Congress and so on and so forth to take these types of actions, which seemingly seems to be dissipating. So I think more so it might just be a case that people are starting to just brush Trump aside. And yes, he's going to be talking, he's going to be quite far-reaching with his comments, but how much of this can we actually take as what's going to happen in reality? Maybe not a lot. So irrespective of this situation, the markets remain pretty robust this morning. As I can see here, US futures are at their record or at highs at the moment, and that's helping the DAX also lift in terms of sentiment. Elsewhere overnight, you've also had some economic data out of Japan. You did have the Nikkei, though. This is one of the intriguing things about how different asset classes can react comparative to your economic textbook, because you read the headline, Japan beats forecasts with an 4% annualized GDP growth, the longest unbroken streak in a decade, and possibly a lifeline for foundering Abenomics. If you look at this chart here, the world's third largest economy recording its best growth streak in over a decade. So you're looking at these consecutive here GDP prints to where we are now at 4%. And yet, if you look at the Nikkei stock index, well, let me just show you the yen. So the yen has weakened, and the Nikkei actually fell overnight. It fell about 1%, bucking the trend of the overall region. It's quite incredible how these correlations tend to work out. I'd say though, if the yen continues to weaken, there'll probably become a point where, well, actually there was a stat I remember reading last night. Let me just bear with me 1 second, I'll get it for you. But it was about, just because of the geopolitical tensions that we've had last week, and also some uncertainty about Donald Trump's future, we've actually had in dollar yen has fallen for 5 weeks in a row. The sequence of weekly losses last extended to 6 weeks, so you'd have to go back 10 years. So the yen has been strengthening, has been the overall theme at the end of last week and the 5 weeks prior. So a couple of things here. Maybe you're just, ripe for a bit of a pullback in terms of market positioning. You've then got alleviation of tensions. The Kospi, the South Korean stock index, which was hit quite heavily and underperformed last week, was up in positive territory overnight. So the yen has weakened, and you tend to get this kind of reversal of patterns, if you like, in terms of how this influences the local market in Japan. But if the yen does continue to weaken, what would typically happen if this emerges as a trend throughout the week is that will help some of the export names recover, and then that should actually start to help the Nikkei in that respect. Okay, a few other things here to have a look at on the charts. Firstly, let's have a look at oil, because I have seen a Libyan related headline this morning. Oil pretty quiet this morning, not really a great deal. If we look on a daily continuation, I'll just take some of these lines off. Kind of sat just this $50 handle, although we've chopped a little bit above it towards the beginning of the month. We had a retest of that towards the end of last week, failed to really convincingly breach that level, and so we're sitting just beneath there at the moment. That low that we had on Friday kind of defining the near-term range that we're in at the moment, which is pretty much 48 to 50. But there were, I remember on Friday night, US rigs were up 3, so we've recommenced a slight movement higher in terms of operational US rigs. But in terms of near-term levels, pivot probably would be a support point if we were to retest the earlier intraday low you printed when Europe first came in this morning. And then in terms of the upside, 48.90 and then the $49 handle, which was up towards the high we printed late on Friday evening. The Libyan headline I just spoke of, essentially that was Libya's top oil field. It looks like the headline should read, it's said to drop maybe production's dropped on security threats. So maybe that's just helping just provide some support to the downside. But we trade pretty much flat in oil, so not too interesting this morning. Actually, it's the equities which are seeing a decent bit of movement, and consequently you can see here really the S&P and the 10-year on the right hand side here, that inverse correlation. So as risk sentiment picks up, coming out of safer havens and moving back into more riskier assets, so you can see the divergent movement in these two products here. Looking at the day in terms of the schedule, today is very quiet, particularly in terms of the US session. So what I'd say is you've already got this risk on sentiment. It'll be interesting to see whether this plays out when North American markets come in and they react to some of the market movement from the European morning. For Europe, we've got industrial production coming at 10 o'clock, but otherwise it's very quiet. We'll have to look at the weekly calendar for a bit more direction, an idea about where the key points of interest will come for the week. And this is, for any of the new guys and the interns, is what you should get in the habit of doing when you're kind of plotting out your strategy for the week, is identifying, whether it's short-term market moves that you may be looking for. That's whether to create an event to trade or to avert excessive volatility. Or if you're doing a long-term strategy, depending on what asset you're trading, what could be the associated risks to holding that trade over X amount of time. And Tuesday, I think, is going to be really interesting, because Tuesday you've got UK inflation rate. Now, as you all know, UK inflation last time out, if I bring up the chart here, we peaked at around 2.9% in UK inflation, and then we dropped to 2.6% last month. Now, the key question here is about where do we go from here? Have we seen the peak, or is this just a one-off blip on the downside and we're going to recommence the move in toward 3%? So this is going to be really important. We've already had the Bank of England. You can see that the argument to remain hawkish, i.e. calling for an immediate rate hike, has probably dropped comparative to where we were a month or two ago. And certainly that 5-3 vote we had 2 months ago seems to be a bit of a distant memory, because we're generally the economy expected in the second half of this year to slow down under diminishing kind of consumer confidence in the UK, a lack of real wage growth, and with prices still higher, should mean the economy should slow down and continue to do so, which should feed through then to less demand, and maybe inflation might start to drop off, which is probably the consensus view of the majority of the MPC. But not forgetting there are still two members, McCafferty and Saunders, who sit on the hawkish side, and they'll be watching this very closely. If this number, let's say hypothetically, was to fall back to 2.5 and below, and we start to get confirmation of this trend that inflation has indeed peaked at 2.9 back in May, then it makes it increasingly hard, you'd think, for the hawkish members to remain of that viewpoint of having an immediate need for a rate rise in the UK. So that would be a really big data point. That's coming on Tuesday, and this also comes alongside a big data point for the US, because that also has been a little bit shaky, has been the performance of the US consumer and their appetite to spend. And so US retail sales also comes out on Tuesday. Wednesday, we then get the latest jobs situation out of the UK, but this is a distant second to the inflation reading, which is the most important event for sterling probably of the week. Then on Wednesday in the evening, you get the FOMC minutes alongside some housing data, and then your regular Department of Energy crude oil inventory numbers. Thursday, so quite a lot coming out for the UK actually, amongst monitoring out for any Brexit developments. You've got the CPI reading, you've then got the job situation, and then you get the UK High Street update on Thursday with UK retail sales. So again, just as important if you're trying to monitor the consumer and what the Bank of England might do next, the price and the spending, they pretty much fit within tandem with each other. The ability to spend being a direct byproduct of how expensive goods are. And so this is going to be very interesting for FX traders. US jobless claims fully fed, industrial production, manufacturing production, alongside Kaplan, Kashkari. So pretty good day on Thursday in terms of the scheduled calendar of events. And then we wrap up the week. You get Michigan consumer sentiment, the oil rig count as per usual, some more Fed speakers as well. So I would say today's probably the most quietest day in terms of the economic calendar. Monday tends to be that way. But if you're looking at the charts from this morning, I'd say that today specifically is all about just maybe identifying some pretty decent technical levels on any further retracement of the move, given the slight de-escalation of the situation in North Korea. So if you're looking at the S&P here, even going back towards Thursday, Friday of last week, given the up move to retest R2 already, which is providing some resistance, any move above there, then be targeting probably around this 24.59 back to the low that we printed on the 9th. Okay guys, gonna leave the briefing at that. So the weekly calendar of events as well I did send out to your inboxes this morning. But any questions that you do have, feel free to leave them in the chat room. But have a good day and have a good trading week as well. Thank you very much.